You think being good with money means knowing when to sell, when to rotate, when to take the gain and move on. At 29, you still believe the smart people are the ones who know how to exit cleanly. What you do not know yet is that the richest people in the room are not playing for exits at all. They are building something colder, quieter, and far more permanent. And by the time you finally understand it, your old way of thinking will feel almost childish. You are 29 years old, and for the first time in your life, people above you have started trusting your judgment without hovering over every word. Your managing director leaves the room when you present because he trusts your numbers enough to let them stand on their own. That small gesture feels bigger than praise. It feels like a rival. You cover mid-cap industrials at a second-tier asset manager in Chicago, and your fund holds billions across dozens of names. But 8 of them are yours. 8 companies, 8 stories, 8 chances to be right. Every morning you get in before 6 o'clock, before the city fully wakes up, before the elevators start filling with people pretending they slept enough. You turn on your 3 monitors, skim earnings releases, read management commentary, scan analyst notes that somehow say everything and nothing at once. You still believe the market is basically honest. Not fair exactly, but logical. A machine for price discovery. Your job, as you understand it, is to find where that machine got something wrong. Then one Tuesday, the machine blinks back. The call comes in just before the close on a gray October afternoon. Unknown number. Calm voice. Too calm. The kind of calm that makes you straighten in your chair before you even know why. The man introduces himself as Garrett Whitmore. He says he represents a family office overseeing $3, $1 billion in private assets. Then he names one of your companies, Arden Industrial. The family owns 22% of it. He says he has read your work. He would like to meet before Friday's earnings call. You say yes too quickly, and the second you hang up, your pulse changes. The office is in the West Loop, but it does not look like a place that wants to be found. No flashy signage, no brand on the glass, no receptionist smiling under track lighting, just a quiet building, a private elevator, and a key card that gives you access to a floor most people will never step onto. When the doors open, everything feels expensive in the most disciplined possible way. Whitmore is in his mid-50s, silver at the temples, open white collar, no tie, no wasted motion. He pours 2 glasses of water without asking, like the meeting was decided long before you arrived. Then he slides a folder across the table, and that is the moment the air changes. Inside are your last 3 quarterly notes on Arden, printed and marked in blue pen, not highlighted, annotated. Tiny notes in the margins, questions, reactions, corrections so precise they feel almost intimate. Someone here did not just read your work. Someone studied it. Whitmore tells you the family bought Arden 11 years ago at $4, $12 a share. It trades around $31 now, more than a 600% return. You not impressed. Then he says they have no intention of selling, and you make the mistake of asking why. To you, the answer seems obvious. The stock looks fully valued. Harvest the gain. Reallocate capital. That is not just common sense to you, it is portfolio management 101. But Whitmore looks at you the way a chess player looks at someone who does not realize they just hung their queen. He does not argue right away. He just starts walking through the math. Federal capital gains, net investment income tax, state tax on roughly $280 million in unrealized gains. A sale would trigger about $80 million in taxes. Gone. Permanently. And suddenly the word profit sounds a little less clean. You tell him that is just the cost of realizing the gain. It sounds reasonable when you say it. It even sounds professional. Whitmore does not flinch. He says, or it's the cost we choose not to pay. Then he slides a second document toward you. A term sheet. A $190 million lending facility. Annual costs 4%. No tax event. No liquidation. No surrender of the underlying position. Liquidity. Simply borrowed into existence while the asset keeps compounding in the background like nothing happened. You do not answer because for the first time in years, you are staring at numbers you understand without fully understanding what they mean. He lets the silence sit there until it becomes instructional. Then he says something that stays with you long after the meeting ends. Our job is to make sure we never have to find another security again. At first it sounds arrogant. Then it sounds elegant. Then uncomfortably it starts sounding true. You came in thinking wealth was about picking winners better than everyone else. He is showing you a different game entirely. Not finding the next asset, keeping the current one forever, while extracting everything you need from it without ever triggering the punishment built into selling. You take the engagement because walking away now would feel like refusing to read the last chapter of a book that just turned dangerous. But in the first few weeks, you realize this is not really about stock selection, or even asset management in the way you were trained to think about it. This is architecture. Quiet, legal, generational architecture. Real estate tucked inside layers of LLCs. Equity positions placed in trusts. Lending lines tied to collateral you would have called illiquid a month ago. And the more you see, the more one thought starts pressing in on you. This family may know something. The rest of the market is never meant to learn. Okay, the first year feels less like a job and more like being quietly dismantled and rebuilt. You are no longer thinking about allocations or sectors or quarterly beats. You are mapping structures. Real estate is not just owned. It is compartmentalized into separate legal containers, each one isolating risk, each one optimized for leverage. Equity is not just held, it is placed inside trusts designed to reset cost basis at death, erasing embedded gains entirely for the next generation. You start to see something unsettling. Taxes are not fixed. They are negotiated through structure. At night, long after the office empties out, you begin modeling what you are seeing because you need to prove to yourself this is real. Scenario 1, the family sells Arden, pays the tax, reinvests everything at a clean 8% annual return. Scenario 2, they never sell, borrow at 3-4%, and let the asset compound uninterrupted. Same return assumptions, same timeline, 30 years forward. You run the numbers twice because the first time feels like a mistake. It isn't. The difference is over $300 million. Not from skill, not from timing, just from what they refuse to pay. The realization lands slowly, then all at once. The advantage is not hidden. It is not even complicated. It is just invisible until someone shows it to you. You wonder why no one teaches this. Why business schools do not center entire courses around it. Why every textbook still ends with the same clean logic: buy, grow, sell, repeat. Then you stop wondering because the answer is sitting in front of you. This is not knowledge meant for everyone. This is structure that only works when very few people understand it exists. By the second year, Whitmore introduces you to another family, older money, quieter money. Third generation. Their assets are not flashy. They do not chase narratives or trends. They own things that feel almost boring at first glance: toll roads, a regional water utility, a network of cell towers. But the longer you look, the more unsettling it becomes. These assets do not care about markets. They generate cash every single month, regardless of sentiment, regardless of cycles. The family has a name for it. They call it permanent income. In one meeting, you sit across from the patriarch, a man who is clearly not needed to prove anything to anyone in decades. He is presented with an offer to sell the water utility. 12 times EBITDA. Sovereign wealth fund buyer. Clean close in 60 days. The implied price is $680 million. You expect questions about valuation, timing, maybe even strategy. Instead, he asks only one thing. What do we borrow against it today? The room shifts slightly. Like everyone else already knows the answer matters more than the offer itself. The answer comes back quickly. About $290 million at 1%. The patriarch nods once, like the rest of the conversation is unnecessary. That's enough for the next project, he says, then thanks everyone for their time. Meeting over. Just like that. The $680 million offer disappears without discussion. And in that moment, you realize something you were never taught to him. The sale was never real. It was just noise. The only real question was how much power the asset could generate without being touched. You walk out of that room feeling slightly disoriented, like gravity has shifted, but only for you. Selling, which used to feel like the end goal, now looks like a kind of surrender. Every asset is not just a price. It is a claim on the world's ongoing productivity. To sell it is to trade something permanent for something temporary. Cash, taxed immediately, spent easily, misallocated often. You start replaying every recommendation you have ever made in your head. And for the first time, some of them feel wrong. By the third year, you are no longer just observing these decisions. You are being asked to build them. A tech founder comes to you with $1, $4 billion tied up in a single equity position. He cannot sell. Not without collapsing the price. Not without triggering a tax event so large it would feel like self-sabotage. He is trapped in success. And you are asked to find a way out without actually exiting. The problem is complex enough to feel like a puzzle you are not supposed to solve. The solution takes months. Exchange funds, partnership structures, legal frameworks that shift ownership without triggering realization. The founder contributes his position into a pooled vehicle. In return, he receives diversified exposure without ever selling his original shares in the traditional sense. The gain is deferred entirely. The legal fees alone are over $2 million. At one point, you wonder if this is too fragile, too complex to hold. But piece by piece, it comes together. And when it closes, something changes. The founder calls you from somewhere offshore, wind in the background, voice lighter than it should be. He tells you he feels like he won something, not money. Not exactly. Something else. Like he just learned a move most people never even see on the board. You hang up and sit there for a moment, realizing your own understanding of leverage has quietly flipped. It is no longer just risk. It is a tool, a way to extract liquidity from illiquid wealth without ever touching the underlying asset. And once you see it, you cannot unsee it. Okay, you start to notice that the very wealthy do not talk about volatility the way you were trained to. They are not obsessed with daily price movements or quarterly drawdowns. They talk about collateral, about what an asset can support, not just what it earns. A building produces rent, yes, but it also secures a credit line at 50% loan to value. That credit line funds the next acquisition, which becomes new collateral, which unlocks more capital. You realize these assets are not separate positions. They are connected, reinforcing each other in ways your old models never captured. The word that starts forming in your mind is lattice. Not a portfolio. A lattice. Every asset supports the others, carries weight, distributes pressure. Remove one piece and the impact is not isolated. It ripples, weakens surrounding nodes, limits future borrowing, reduces optionality. Selling is no longer a clean transaction. It is structural damage. And suddenly, every take-profit decision you once admired starts to look dangerously short-term, like cutting beams out of a building to celebrate how strong it once was. In the fourth year, you are brought into something more delicate. Quietly, a publicly traded holding company is under pressure from an activist investor demanding they sell off their real estate assets. The activist's argument is clean, almost textbook perfect. Unlock value. Improve efficiency. Return capital to shareholders. You recognize the logic immediately because it is the same logic you used to believe in. For a moment, you feel pulled back to your old world. Then you see the numbers behind the structure, and that pull disappears. The controlling shareholder owns 41% of the company. 2 generations of family ownership. The cost basis on the real estate is negligible. The embedded gain is massive, nearly $1 billion. A sale would trigger hundreds of millions in taxes before a single dollar could be reinvested. But that is not even the most important part. The assets generate over $30 million a year in income. Quiet, steady, uninterruptible income. And they anchor control over entire sections of the city, control that does not show up in any spreadsheet you can build. You sit with the numbers late into the night, trying to model influence, trying to quantify something that refuses to be reduced to a cell. Owning those buildings means controlling leases, relationships, access. It means deciding who enters certain markets and who does not. That kind of power compounds differently. Not in percentages, but in positioning. You realize the activist is right about valuation, but completely blind to structure. And for the first time, you are not on the side of being right. You are on the side of not being dismantled. You help design the defense, not by arguing, but by restructuring. A recapitalization that returns capital without forcing a sale. A leveraged dividend that extracts liquidity while preserving ownership. A partial REIT conversion that gives the activist enough of what they want to leave without forcing the family to give up everything. It is not clean. It is not simple. It is engineered. And when it is presented, there is a moment where everything could still fall apart. The activist reviews the proposal. Days pass. Silence stretches longer than it should. You start to feel that familiar pressure again. The one you used to feel waiting on earnings reactions. Except now the stakes are different. This is not about being right or wrong on a model. This is about whether an entire structure holds or collapses. Then the response comes. The activist accepts, not fully satisfied but no longer pushing. The assets remain. The income continues. And something inside you shifts again. Whitmore looks at you after the meeting and says almost casually, "You understand now." And you do, more than you want to admit. The city blocks stay. The cash flow stays. The control stays. Nothing was sold yet, liquidity was created. Pressure was relieved without dismantling the machine. You realize this is the real game. Not maximizing return in isolation, but preserving systems that generate return indefinitely. Systems that survive pressure, absorb shocks, and keep producing. You begin to see selling differently. Not as a victory, but as subtraction. Permanent subtraction. When an asset is working, producing income, serving as collateral, compounding quietly in the background, selling it removes more than just its price. It removes future leverage, future options, future deals that could have been built on top of it. And in exchange, you receive cash. Cash that arrives already reduced by taxes, already exposed to inflation, already waiting to be deployed into something less certain. The contrast becomes impossible to ignore. Cash sits, it waits, it erodes. An asset moves, it produces, it supports. The wealthy do not sell because they understand this difference at a structural level. not just a conceptual one. A toll road does not stop collecting because the market is down. A utility does not pause because rates change. And the owner does not need to touch the asset to benefit from it. They borrow against it, pay a lower cost than it earns, and capture the spread. Then they repeat. And somewhere in that repetition, the game starts to feel endless. Okay, by now you no longer think in terms of returns alone. You think in spreads. The gap between what an asset earns and what it costs to borrow against it. That gap is where the real engine lives. A toll road yields steady cash, but the credit facility tied to it costs less. The difference compounds quietly, almost invisibly, into the next acquisition. Then that acquisition becomes collateral, unlocking another layer. You realize this is not growth in the traditional sense. It is recursion. And recursion left untouched becomes something close to exponential. You start seeing tax differently too, not as a rule, but as a variable. Something that changes depending on how you move, how you structure, how patient you are. The family that sells triggers it immediately. The family that borrows delays it indefinitely. The family that holds until death erases it entirely through a stepped-up cost basis. Same asset, same gain. Completely different outcomes depending on decisions that never appear in a standard model. You begin to understand that tax is not just a cost. It is a design problem. And every wealthy family of duration has someone solving that problem. An architect. Not visible in headlines. Not listed on org charts in any obvious way. But always there, shaping the flow of ownership, debt, and time. You realize that most people never even know this role exists. They see the outcomes, large holdings, stable wealth, but not the structure underneath. Now you are inside that structure, and the more you learn, the harder it becomes to explain your work to anyone outside of it. Your network shrinks in size but expands in weight. Fewer conversations, but each one carries more consequence. You stop talking about what you actually do in most rooms because the gap between what you know and what can be said becomes too wide. When someone asks what you work on, you give answers that sound true but feel incomplete. Because how do you explain that the real game is not about making money, but about never interrupting the systems that make it? There are moments when the silence gets heavy. When you sit alone, late at night, looking at structures that span decades, sometimes generations, and realize how small your original understanding was. You used to think in quarters, then years. Now you are thinking in lifetimes. And something about that shift feels less exciting than it should. Because the longer the horizon becomes, the less room there is for mistakes, and the more permanent those mistakes become if you make them anyway. Then the next project arrives, and it is larger than anything you have touched before. An offer on the table valuing the asset at $2, $8 billion. Embedded gain $1, $9 billion. The tax exposure alone could reach $500 million depending on how it is handled. The numbers are almost abstract at this scale, but the consequences are not. Every decision here echoes forward for decades. You are not just modeling outcomes anymore. You are shaping futures you will never personally experience. The structure you begin building spans multiple jurisdictions. Legal entities layered across borders. Timing strategies aligned with regulatory windows. Every piece has to fit precisely because the margin for error is gone. And hovering over everything is uncertainty. The IRS has already been watching similar structures. A comparable deal from another family office was challenged just weeks ago. No resolution yet. No clear precedent. You are building something that might be tested, and no one can tell you how it will hold. For the first time in years, you feel something close to fear. Not panic. Not doubt in your ability. Something quieter. The awareness that you are operating at a level where being wrong does not mean a bad quarter. It means irreversible loss. Hundreds of millions redirected permanently because a structure failed under scrutiny. You double-check everything, then check it again. And still there is a part of it you cannot fully control. And that is what stays with you. The timelines tighten. Tax counsel needs 3 weeks. The consortium's exclusivity window closes in 6. Every day matters now. Every delay narrows your options. You hold the entire structure in your head like a map with too many moving parts. One misstep, one misinterpretation, and the whole thing shifts. And yet outwardly everything remains calm. Meetings, emails, quiet conversations behind closed doors. No one raises their voice. But the pressure is constant, invisible, and heavy. And in the middle of all of it, you realize something unsettling. You do not own any of this. Not the toll roads, not the buildings, not the equity position. You are the one holding the map, but not the territory. You move pieces, but the board is not yours. And still, you feel responsible for outcomes that will define families you will never belong to. Another call comes in. Another structure. Another embedded gain waiting to be preserved. The game does not pause. It just moves forward whether you are ready or not. Okay, somewhere along the way, you stop thinking about wealth as something you accumulate and start seeing it as something you protect. Not from markets, not from volatility, but from interruption. The real threat is not losing money. It is triggering the event that forces you to give part of it away permanently. A sale, a realization, a moment where the system breaks and converts something alive into something static. And once you see that, every decision begins to revolve around one question. Does this preserve the machine, or does it weaken it? The phrase "we do not sell" stops sounding like philosophy and starts feeling like policy. Not emotional, not stubborn, engineered, codified across generations, 4 generations deep in some cases, passed down not as advice but as instruction. You begin to understand that wealth at this level is not just capital, it is discipline. Discipline strong enough to ignore offers that would change most people's lives overnight. Discipline strong enough to wait, borrow, restructure, and outlast instead of cashing out. You think back to your old models, clean spreadsheets, discounted cash flows, sensitivity tables. They all assumed one thing, that at some point you exit. That realization is part of the cycle. Now you see how incomplete that assumption was. Because if you never exit, the entire framework changes. The objective is no longer maximizing terminal value. It is eliminating the terminal event entirely. And once you remove the end, the strategy becomes something else entirely, something far harder to compete with. There is a moment late one night when it finally clicks in a way you cannot unlearn. You are not in the business of picking winners. You are in the business of preventing endings. Every structure, every loan, every trust, every legal layer exists to extend continuity, to keep assets alive, productive, and untouched for as long as possible. And the darker realization sits just beneath it. The longer something compounds without interruption, the harder it becomes for anyone outside that system to ever catch up. You start to see the divide more clearly. Not rich versus poor, not even wealthy versus not, but those who understand structure versus those who only understand transactions. One group is constantly buying and selling, reacting, adjusting, paying along the way. The other group is building systems that make reacting unnecessary, systems that absorb shocks instead of responding to them. And once those systems reach a certain scale, they stop feeling like portfolios at all. They start feeling like infrastructure. The emotional weight of it creeps in slowly, because there is no finish line here. No moment where everything is done and you step away. The system must be maintained, defended, adapted. Always. New regulations, new scrutiny, new variables. The machine keeps running, but only because someone is always adjusting the gears. You realize that permanence is not passive. It is active, relentless. And for the first time, you understand why so few people are invited into this world. You think about the founder on the boat, the patriarch in the meeting, Whitmore across the table. None of them ever celebrated a sale. Not once. Their victories were quieter. A structure that held, a tax avoided, a position preserved, wins that do not show up in headlines but compound just the same. And you begin to understand why it all feels so invisible from the outside. Because the most important moves leave no trace at all. The markets will open again tomorrow. They always do. Prices will move. Analysts will upgrade and downgrade. Headlines will declare winners and losers. And somewhere inside all of that noise, these structures will continue doing exactly what they were designed to do, generating income, supporting leverage, avoiding realization, quietly expanding. The world will call it investing. But you know better now. This is not investing. This is control. Another file lands on your desk, another position, another embedded gain, another decision that will determine whether something continues or ends. You no longer feel the rush you used to feel at the start of a new idea. Instead, there is something heavier, more deliberate. You are not chasing upside anymore. You are protecting continuity, and every time you succeed, nothing happens. No announcement, no celebration, just silence. And then the system keeps going. You started this journey believing the smartest people knew when to sell. Now you understand the truth is far less comfortable. The smartest people build lives where they never have to. They borrow instead of liquidate. They structure instead of realize. They hold through time in ways most people never even consider. And the final realization, the one that stays with you longer than anything else, is the game was never about making money. It was about keeping it alive forever, and most people were never even playing the same game.